little bit on the banking regulations and also walk you through the timeline as well, because many of us have heard the names Basel I, Basel II, Basel two and a half, 3, and whatnot, isn't it? So we will go through this timeline that will help us understand how the Basel guidelines have progressed over time. Because then Basel are very, very important regulatory guidelines which are followed globally. So they are defined by the Basel Committee of Banking Supervision. We put an acronym of BCBS for this. So BCBS was set up back in 1974, and it's an organization which is based in Basel, Switzerland. And it's a firm or it's an organization which recommends banking regulations. And you'll observe that most of the regulations which we see globally, they are linked to this BCBS. So you'll observe almost a similar regulation will be seen. So let's say if I take an example of maybe RBI in India. So the Reserve Bank of India is the central bank for the Indian market. So then they will take the BCBS regulations and then they are going to fine tune it for local Indian market requirements. So similar ideas you'll observe globally as well, whereby globally banks are going to use this guideline as a reference and then they can make some changes depending on the local market requirements. So let's walk through the timeline for these different Basel, so right from Basel I up till the FRTB one. So starting with Basel I. So going back to 1988, there was agreement between banks to calculate regulatory capital in a uniform manner. Because then the idea was that the bank should follow a certain standard methodology to so that there is a certain standard way in which things are computed and calculated. Now, initially, this was designed to cover losses from loan defaults and derivative contracts only. Then in the 1990s, there was a recommendation on inclusion of capital for market and credit risk as well. And the reason behind this was also very, very logical because there was increased trading activity by banks around that time, and that warranted that there should be an increase in capital which you can allocate for market and credit risk. Then come 1998, the implementation of market risk amendment. We also call this as the modification of Basel I, which was introduced. Then coming to Basel II. So around year 1999, there were recommendations to enhance the credit risk capital computations, which were there. And there was also a requirement or a recommendation for inclusion of capital for operational risk. Because around this time, banks realized that that is a very, very important component of risk which cannot go unchecked. So that's why there was a focus on inclusion of capital for operational risk. So it took nearly 8 years, I would say, for the final Basel III rules to come into play and before they were implemented. As a result, the total capital charge now can be thought of as a sum of market risk, credit risk, and operational risk. So if you observe something here, it is in line with the point which we mentioned on the earlier slide. There is no diversification benefit. So if you see, it's a simple addition of the three components, and we are not subtracting any diversification benefit as such. So, so this was around Basel II. Then came Basel 2.5. So this was after the global financial crisis, which hit the market around 2007, 2008. And the market realized that there were regulatory loopholes which banks were capitalizing on. So then there was a requirement that regulation should be strengthened further. As a result, after this, there was a amendment which was done in order for the way in which market risk capital charge is calculated. And this is something which we call as the Basel 2.5. Then came Basel III. So BCB decided that there should be an increase in the equity capital requirements to be satisfied by banks. And you'll observe that equity capital is something which we calculate as a part of tier one capital. So that's like one of the most important source of capital for the banks. So, so equity capital requirement came into being and banks had to satisfy that requirement. So this set of regulations required increased equity capital charge by banks. It was recommended by the Basel Committee. And then the more recent ones like FRTB. So there was further revisions which had come into the existing framework because then regulators want to strengthen the overall way in which the risk calculations are happening. And FRTB, which we call as the fundamental review of the trading book, is another step in that direction that can be thought of as an enhancement over the current Basel III framework. And that is something which is globally getting implemented. Uh, of course, now the milestones which have been set by the regulators globally, that is different across markets. But that is already underway as we speak, and different jurisdictions are getting FRTB rolled out at the respective timelines or respective milestones which their respective regulators have defined. So this was a little bit on timeline as to how the regulations have progressed over the years. And as we see, there is a growing awareness that there should be more and more stringent regulations which should come into play. So that's why starting from Basel I, we see how things are getting strengthened as we move down the scale right up till the FRTB.